Good morning, everybody. This is the live market open for January 20th. It's Wednesday. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. And we certainly have a busy show. As usual, we'll talk about recent developments, the turbulent ones, talk about charts and levels. We had quite a few breakouts. The next 24 hours, busy as well. And of course, your questions yesterday. And well, in general, we have excellent questions and keep them coming. So if you cannot see the chat box alongside the video, please go to the address here on the screen, tlk.io/fxstreet-forex-live-video. Okay, let's begin with the United Kingdom, with the UK. God save the Queen. Inflation data beat expectations with a rise of 0.2% in the headline and 1.4% in the core. But this was only good for a few minutes, 2 hours or so, until Mark Carney, the Canadian governor of the Bank of England, came, and this is what happened. Boom. We had quite a fall. This is the rise on inflation numbers right here, above 143, and then came Carney. What did Carney say? Basically, he said the headline, the biggest headline, makes things quite clear. He said this is not the time to raise rates, all right? What else did Carney say? He also talked about slowing wages, about worries about China, worries about the Eurozone. In any case, contrary to a few previous public appearances, Carney saw the glass half empty, okay? Not half full, seeing the darker side, basically reflecting the worries that we're seeing in markets in the past few weeks, and a few negative figures of the US economy. He gave the speech in the University of London, and it was all dovish. So we had a clear fall initially just to support to the ropes at 142, but then we had a loss of that line and reached a low. Well, this morning, this morning it's 141.33, but we've touched a bit lower ground yesterday, just under 141.30. Anyway, we're back to levels last seen in 2009. That's what Carney did. A clear breakout. Oh, we have to use the monthly chart to see the fall. All right. Following your comments yesterday, I cleaned up the charts a bit, at least this one. So I hope it's clear. Anyway, any feedback is of course welcome. As you can see, we're back under the 2010 low here of 142 and something, and now we're back to levels last seen in March of 2009. In those days after the global financial crisis, pound dollar reached a low of around 135. Basically, I see support for the pound at the round number of 140. It's easy because it's just a round number, and the next support only 135. Of course, it won't go that quickly, and perhaps we'll have a rebound, but yeah, so we could have quite an interesting move over there as well. I see a question here from Fabian. Good morning. Good morning, everybody. Jax. Reg. Lower than expected German PPI this morning, but not pushed euro down. Yeah. It's a bit frustrating if you're trying to trade indicators on euro dollar or in general trying to trade euro dollar. Okay, let's look at euro dollar. Currently 109.46, around this weak resistance line of 109.50. We already crossed this line. 110 is of course support above. In general, what do we see here? A move in the past 24 hours to the upside. Why to the upside? Because we have a flight to safety. Doom and gloom in the markets. Carney is one of the reasons. Worries about China, another fall in oil prices. So we had a new factor from Carney, but also other factors that are already in markets and they're moving lower. Stock markets fell. Officially, the Nikkei, the Japanese stock index, is in a bear market. And well, according to those definitions of a 20% loss, so we have 20% since August, and yeah, and we have all this doom and gloom. When things go bad, currencies that were used for funding riskier assets like the euro and the yen, cheap lending in euro yen in good times leads to a devaluation of these currencies, but when things become worse, we have a strengthening. So we have euro dollar stronger with the fall of stocks in Asia and with the worries from Carney and everything else. But the move is not that significant. because we're still in range. Let's zoom out a bit. This is the big rise that we've seen from Draghi in early December. Since then, we've been above 110, almost 110.70, and we've been also to 107.10. Currently, we're in the higher end of the range, but not very far. Now, this German PPI that was worse than expected, is one of the pressures on the pair down, but there are also small pressures on the pair up, and the biggest mover, as aforementioned, is the safe haven flows. Good times, euro falls; bad times, euro rises. Yesterday, we had interesting positive figures from the Eurozone. We had the German ZU indicator, the economic sentiment, beat expectations with 10.2, and also the current conditions component came out better than expected. Okay, only the all-European one fell a bit, but all in all, these figures are in positive territory, and they came out better than expected. There were no surprises from the final Eurozone inflation figures. They were confirmed at 0.2 in the headline and 0.9 in the core. So this was a non-event. At the same time, we had the German ZU, so this was sort of positive, okay? But these are really, really minor. What's moving markets more is, for the euro, two things. Of course, safe haven flows, which is a big factor. But in recent days, it's also tension towards the ECB. Tension can do two things. First of all, tension makes moves in markets a bit more limited, okay? So that's another reason for the frustrating ranges in euro-dollar, that all this safe haven rise is limited in comparison to the yen, and moves are limited in comparison to other currencies. But the second factor is also the ECB, that maybe the ECB will act as well. So we have safe haven flows moving into the euro, and we have tension towards the ECB, and given the recent events, it could turn out that the ECB follows the other central banks, like yesterday, Mark Carney with the Bank of England, and today we have a rate decision in Canada. They're expected to cut or at least be dovish, okay? Even though the Canadian dollar fell so much, we're going to talk about that soon. So, yeah, the webinar is going on. Refresh it if you cannot see it. Let me write that on the chat just to make sure. So what Mario Draghi could do is that Draghi could also join these currency wars. Draghi could also, contrary to what other hawks in the council want, and contrary to maybe a more balanced approach that he would like, given the GDP of China, that it was weaker, even though at first perceived it as not so terrible. The falls in stock markets, what Carney said, what the Bank of Canada might do today, weak inflation figures in other places as well. We'll see today from the US. We could have a more dovish talk, and maybe the market is beginning to fear that and limiting the gains of the euro. In any case, I expect euro-dollar to remain very, very much limited in range until tomorrow. Or if we have a leak from the ECB, I was talking about a leak yesterday, I was talking about a leak on Monday. So far, I haven't heard anything. So euro moves mostly by safe haven flows, tension towards the ECB, and some indicators, but not so much. Okay, so I hope that sort of explains the frustration in euro-dollar. Let's talk about more events yesterday. We had milk prices in New Zealand fall by 1.4%. There were no expectations, but anyway, fall is of course negative, and CPI fell by 0.5% quarter over quarter, worse than expected, significantly worse than expected. Let's take a quick look at the New Zealand dollar, see how the once resilient Kiwi lost further support, 63.57, 0.8% on the day. Basically now trading in the lows, extending its falls if you wish, in the wake of the European warning. It's the lowest level in quite a few months. Let me see how many exactly. So we've seen these levels back in October. Okay, so these are 3-month lows, but you can see here this double top on the daily chart on Kiwi dollar, losing here critical support. And next support line is at 63.10, and then 62.40 is much stronger support. So the Kiwi is one of the stronger commodity currencies because of milk, that is less vulnerable than metals that Australia exports or oil that Canada exports. But in general, Also, the kiwi feels the heat from China, and also now milk prices and CPI. The fallen CPI implies perhaps further cuts. So far, we didn't expect new cuts from New Zealand, but now it's on the cards. I see here a question. I found I can buy for delivery, not ETF, Dakota crude for only 0.5, only 0.50 cents a barrel. But where do I store it? The Dakota sour crude. I must say I don't follow these specific indicators in oil. I follow the two indices, especially WTI crude oil, West Texas Intermediate, and of course the Brent, which is also relevant for oil prices in Europe. Anyway, let's before we move to CAD, let's take a look here at oil. 28.73, a bit rising a bit on the day after touching the lows of 28.26, a bit under previous levels. 28 is some sort of support. 30 line that we almost reached yesterday on this better mood on this. Okay, China is not doing so bad. Let's take it a bit higher. And then we had the crash once again. Okay, so this is the move on China is actually not terrible. And then Carney renewed worries about China. Everything's going wrong, falls in stocks, and we reached these lows. Then we had some kind of a rise. But anyway, look, the trend here is clear. It's a downtrend. Technical lines are also relatively clear, and the direction is down. Okay, I'll talk about Canadian dollar and then answer that question. Canadian dollar, each time I repeat this, it hits the sky. I mean, dollar CAD, 146.40 this morning, 146.54 is the high. Where's the next line of resistance? I really don't know. Only when we have the pair marking a high and then sliding a bit, I can say, okay, this is resistance. And we had this line here of 146. So sorry. Yeah, 146. Served as resistance for a day or so before we fell to support here at 144. Very nice range trading, and then another move to the upside. And okay, we'll talk about the Bank of Canada. I'll try to answer the questions and then talk about the BOC. Okay, a question from Fabian. I couldn't understand the statement from Morgan Stanley published on Forex Crunch. Would you kindly explain it? The euro benefits from safe haven flows unless the ECB does reduce its deposit rate further. However, the outcome of the December meeting and recent ECB communications suggest that a further deposit cut is a less preferred policy tool compared to QE. The problem is that additional QE may not impact the yield curve sufficiently to weaken the euro. Yeah, okay. I think both tools are effective, and markets expected in December just more of both. A further cut of the deposit rate, not only 10 basis points, but perhaps 20. And QE just wasn't raised at all. Okay, so it stayed at 60, was expected to rise to 70 or 80. They did extend it to March 2017 and did announce a reinvestment of proceeds, but it was below what markets had expected. Given the minutes, given the reports from Reuters I talked about last week, expectations, of course, are now for no change, and perhaps no hint of a change in March, because we need new forecasts, because the ECB has already done a lot, because governments need to do more. Because lots of stuff. Okay, so that's my rationale. Can't explain Morgan Stanley's, but that's more or less what they said, that the ECB just did a lot and is unable to do more at the moment, especially not in what hurts. Remember that what the ECB does eventually can backfire, because all this printing of easy money, all this negative deposit rate sent money out of the Eurozone. Yes, we had Euro-dollar weakening a lot. Basically, it worked. But when we have a flight to safety like now, it's not enough to stop the strengthening of the euro, and the ECB could be expected to do even more, okay? Anyway, we have other bank recommendations that think that the ECB, given the current environment, given the weak inflation, will hint that it'll do more. There is a risk to credibility. That is, ECB hinted about doing a lot in October and then didn't do enough in December. So will they hint about doing something in March, now in January, just to keep the euro low? Will markets believe it? What happens if they under-deliver once again? Remember, the ECB had a lot of credibility of under-delivering, under-promising and over-delivering. So it might not want to risk that again. So maybe that's another thing they refer to. Anyway, I believe that Draghi will try to talk down the euro without promising anything. We'll do a full preview of that tomorrow. Okay. Hope this answers the question. Yeah, a comment here from Carol. Hi, Carol. Important results for the USA and Canada. How might this impact upward trend in dollar CAD? We'll talk about that very soon. I'll just complete the answer about euro dollar. Indeed, the biggest events come today from the US and Canada. Why? Unless the ECB does reduce its deposit rate further, if it reduces it more, there will be more safe haven flows. Right. But if they reduce it and surprise markets by doing that, they send more money out of the Eurozone, and they might it might overwhelm the safe haven flows. Look, in general, what the ECB has done, it does trigger the safe haven flows, but the general direction remains. I mean, the general outcome is a lower euro for longer. We were at 140 in May 2014, just before the ECB announced its measures. Another question here: ECB overnight liquidity operation shows that excess liquidity in the euro area stands at operation. I don't think these figures have a lot of impact. These are standard figures, so if we see any huge changes over there, it might have an impact, but these changes of 640, 638, to answer your question, are not, I don't see them as moving markets. All in all, the ECB manages its operations, the buying of bonds, lending to banks, everything goes very smoothly, so these weekly figures or daily figures are not, I don't see them moving markets, okay? Now let's see if I didn't miss any event for yesterday. No, let's talk about the events for today before we reach the events you mentioned. Carol, right? We in USA and Canada, we have a report from the United Kingdom. We have the jobs report in the United Kingdom, and wages stand out. Okay, so here are the reports. We have, it's a busy release. The most important thing that markets are looking at now is average hourly earnings or wages. Wages rose very nicely in the United Kingdom, reached 3% year over year, stronger than the United States, but the previous month in the report for October, they fell to 2.4, a big fall. Vindicating what? Vindicating Carney, what Carney said, that the growth in wages is flattening. This time an even bigger fall is expected to 2.1. Let me enlarge the font here just a bit. So this is these are low expectations. So any small beat could allow the pound to recover just a bit. Okay, and we have also the excluding bonus figure. This is expected to fall from 2% to 1.8. I would say that the wider figure, the one including bonus, is a bit more important. And they usually both move in the same direction. There's absolutely no difference in the trend. So this is the most important figure to watch, because we know that the employment situation is good. We know that wages, we knew that wages were going up, but now we know that that it's not going as expected. Okay, these are figures for November, not from December. They're not extremely fresh like in the United States, but they still have a lot of impact. Okay, unemployment rate for November is expected to stay at 5.2%, a low unemployment rate in the UK. In this sense, it's looking good. Of course, the problem is that wages are not moving fast enough, and that housing in the UK is very expensive. The really fresh figure comes from the claimant count change. Claimant count, right? No, sorry, it's not this one. It's this one. Basically, it's like jobless claims. And that's a fresh figure for December. So it rose last time 3.9, now expected to rise 2K. It used to be the most important figure because it's fresh and because it tells us the direction of employment. It's still important, of course, but wages are now the focus. Okay, so this is a big event for the pound. A second day of big event for the pound. Yesterday was even more with what Carney did. All right, and then Then nothing significant coming out of Europe or anything else. And then we have the focus on, first of all, the United States. Okay, we have inflation figures. The consumer price index. The most important thing to watch is core inflation, and the wider measure is, of course, year over year. So it's, let me see, it's this figure. Expected to rise core inflation from 2% to 2.1. Remember, why am I saying it's important? It's always important, but this time it's even more important because the Federal Reserve specifically warned about inflation, expressed concern that inflation is not rising fast enough, that despite good expectations for the future, the present doesn't look good, okay? So that's, of course, we have to watch this very, very closely. Okay, and we know that headline inflation is weak because of oil prices, but core inflation, it looks better. The Fed always tells us it's transitory, the falling oil prices, and also that the effect of the the stronger dollar on core inflation is transitory. Let's see if this is true. Actually, we're expecting a small rise from 2 to 2.1%. On the month-over-month figure, we're expecting... where's this figure? Or a small rise of 0.2, like in the previous month. Headline inflation year over year expected to rise from 0.5 to 0.8. Why are we expecting a rise in headline inflation despite the recent fall in oil prices? Because it's a year over year figure. And we're beginning to see the elimination of the base effects. Okay, so the base effects that means the bigger fall in oil prices that we've seen late in 2014 and in early 2015. The biggest fall came in November. Now it's the report for December. So we had a big fall in oil prices in December 2014, and we also had a fall in 2015, but not that bad. And so now we're beginning to see these base effects move away. Okay, so this is also important, but core inflation is more important. Month over month, from November to December 2015, 0% change, okay? Now, at the same time, we also have inflation. We also have housing figures from the United States. I think they'll play second fiddle to inflation. Housing data, building permits for December are expected to slide just a bit from an annualized level of 1.289 to 1.2. And housing starts, they're expected to move up just a bit from 117 to 120. These figures can go in opposite directions. They can have revisions to the upside or to the downside. When they're published on their own, they have more impact. But today, and with the new focus of the Fed on inflation, I think they will be overshadowed. Okay, before we move to Canada, I see more questions. Do you have their book from Yohay? I have a small ebook that you can download on my site, not the full book. Question here, with Carney saying rate hikes have been moved from August 2016 to February 2017, should we not expect the general trend to sell pound? The pound, I don't think he said anything specific about February 2017, but these are the implied probabilities. Basically, he said it's just not the time, and the market said, okay, it'll not this year in general. Yeah, this puts lots of pressure on the pound, but remember, let's look at the chart of the pound. This is what's going on with the pound. It fell so much. So we could also have a violent correction in pound dollar if we have some kind of better than expected figures. So I'm not sure. It's not a one-way street. And if we have, let's say, a very dovish ECB and also the Fed going dovish, then we could have a recovery in the pound. So, and especially in these conditions where you may say it's a bit oversold. Okay, that's quite a trend there. Let's look at the daily chart. It's even this is daily chart of cable. I would say it's extreme. Okay. Okay, thanks everybody here for helping each other and looking for the ebook. You can download the ebook and the 5 most predictable currency pairs on Forex Crunch by subscribing to the newsletter, and you'll also get weekly updates. Anyway, let's continue. Let's talk about Canada. I know not many of you are trading the Canadian dollar. I think it's a fascinating pair, especially in recent months. The big event today is the rate decision from the Bank of Canada. I can recommend a video preview that Adam Button of Forex Live did on his website on Forex Live to the big event. In general, they're expected to cut interest rates because of the fall in oil prices and because of the potential damage to the Canadian economy. They want to support the local economy by making lending cheaper. Okay, we went from a month ago to more or less zero chances for rate cut in Canada because oil prices were weak, but the Bank of Canada was sort of everything's okay and inflation is not too bad. And you know, if in general, the governor there of the Bank of Canada, Polos, I'm not sure how to pronounce his name. He's relatively optimistic and positive guy. But then with the new falling oil prices and new gloom and doom, markets change their opinion, and now a rate cut of 0.25% is what's priced in. Not fully, not consensus, and it's uncertain at all. I suggest you watch that video preview of no, not juicy gossip, but I think it's useful stuff there. To answer your question, what I said about the Bank of Canada is that they might, because of the big question is, will they cut interest rates to support the economy? That makes sense, right? And they said in the past that they're not in the distant past, and I think in November, that the lower bound for interest rates is actually negative, it's minus 0.50%, and it's currently plus 0.50, so they have a lot of room to cut. Okay. On the other hand, because of the fall in the Canadian dollar, this huge fall, let me put that chart on the screen once again, we might have the Bank of Canada saying there's no need to cut rates. Once again, this is dollar CAD, okay? Also, more or less a one-way street, especially in the past 2 weeks. High volatility, which may be undesired, and especially here I suggest you take a look at this video preview. Did a great job there. Anyway, what I'm saying is that they might opt not to cut rates, keep their powder dry. No, markets are doing their work for them, so everything's cool. No need to act, and so that's another option. But they may be dovish and not cut. It's also an option, and that would keep the pressure. I see the pair, of course, moving with oil prices as well, and if we have some kind of recovery in oil, we could have recovery in the pound. And even if the Bank of Canada is optimistic and we have a fall in oil prices, we could still see the loonie fall again. But I see the Canadian dollar as a bit stretched, and we could have some kind of correction before the next move, to the downside in CAD and upside on dollar CAD. Okay, so I'm not sure it's going to be an extension, but if the Bank of Canada goes dovish and cuts rates and says more cuts are coming and express worries and not optimism, then 150 is the next stop. Like with other, we're currently at levels last seen, not in 2009 or 2010, but in 2003, April 2003. That's when the US-led coalition was still invading Iraq before they entered Baghdad. So you can see how historic that these levels are for dollar CAD, okay? So I think it'll be very, very lively over there. So we have the rate decision in Canada at 3 GMT. Half an hour later, crude oil inventories. Let's see if we have expectations for that. Remember, it's not only the crude oil inventories, as we've learned, it's also the distillates. We also have the API data, but where's that? Yeah, anyway. And we also have at 1:30 GMT, we have the manufacturing shipments figure and wholesale sales from Canada. These will probably be ignored as markets expect the Bank of Canada. The most important events are the statement itself at 3 GMT, and then the press conference by the Bank of Canada by close in Ottawa at 4:15 GMT. Very exciting day for the Canadian dollar, which in general is more exciting than many Forex traders think. Okay. Do you think questions here? Let's see if I missed anything. Yeah, well, comment from Fabian, you didn't get the ebook. Yeah, I first send out the most predictable currency pairs, and then the ebook is released a few days afterwards. Okay. Do you have a link to this Canadian interest rate report video? Oh, yeah, I put it on. Yeah, sorry. You already thanked me. Okay. I'm reading the comments a bit slowly. Sorry for that. Anyway, these are the big events for the day. I think Canadian dollar, again, is a bit overstretched, but who knows? You could have said that also a week ago and would also be correct. And since then, well, more supply in markets from Iran, and less demand from China, or less perceived demand, and we have further falls. 146.60. Wow, it's just unstoppable. Okay, let's talk about other currency pairs. We didn't talk about the yen. Yen safe haven, working perfectly as a safe haven. 116.12, a fall of over 1% today, with the Nikkei going into a bear market. I think we're getting close to the line in the sand for the Bank of Japan. We're currently at levels last seen right here in August, when the Chinese stock market crashed. So this is a significant fall, but I think 115 is the more important line because it's a rounder number, and it's a level seen also around the turn of the year, around when the sort of the lows, after the Bank of Japan announced its second round of QE. We might begin hearing different tunes from the Bank of Japan about readiness to act and things like that. Of course, participating in the currency wars against their big rivals, China. The third largest is Japan. The second largest is China in terms of size of the economies. And of course, Chinese yuan did stabilize in recent weeks and in the recent week, sorry. So I haven't talked about that too much, but of course, they don't like the strength of their currency against the US dollar and quite a lot of other currencies in emerging markets and elsewhere. Okay, so that's the Japanese yen. 115, I believe, is the line for the Bank of Japan and also for markets to begin fearing. 117 and 117.30, this range sort of is now resistance. For a move to other currencies, what US CPI movers can move euro dollar up to what resistance or support? Euro dollar is very limited in range. Look, see how it's the hourly chart. Look, during the show, look what a big fall we're seeing here of over 70 pips in dollar yen. All right. In the meantime, euro dollar also, we're seeing a strengthening of the euro against the US dollar, but that's 20 pips only. Okay. And in general, it's 0.5% higher euro dollar, and while dollar yen is over 1% lower. So I expect a very limited reaction. What levels can we see? If we have, let's say in core CPI, we have over 2%. We have over 2.1 that is expected. We have 2.2 or 2.3. And perhaps also headline CPI above expectations, let's say 1%. Then we might say, okay, the Fed is going to hike in March, and things are looking better for the US dollar, and the US dollar is going to strengthen across the board. Again, this doesn't mean necessarily a huge strengthening, because it means bad news for markets with more interest rates. It means another flight to safety to the euro and the yen, but the euro and yen could still weaken just a bit against the dollar, so maybe 110 could be challenged. Sorry, maybe it could fall back to 109. Okay, weaker euro there, but not something huge. And the next level is 108. No, maybe it could fall below 109, let's say. Okay, and if we have a figure that is weak, means a weaker US dollar across the board. Then we could have a challenge of 110, and 110.70 is the next level to watch. So it is an important event for markets, but euro dollar is very limited range pair at the moment. Okay, let's move to more currency pairs. Very busy show today. Lots of movements in markets. Aussie dollar had its time in the sun when GDP in China was perceived as all right. We had a move above 69, but we never reached higher levels, much higher levels. We never challenged 70. Now we're back to 68.50, support at 68.30, and these are the lowest levels in since 2009, March 2009. So if we have a break below 68.30, we could have a more rapid fall. Australian dollar suffers from Asian stock markets, from a lower consumer sentiment figure in Australia, a bit minor, but also contributes, from Mark Carney as well, from his dovish comments. Everything looks a bit more negative today for the Aussie. I've written about 5 reasons for the fall of the Aussie, but it's mostly just the doom and gloom in markets. The Australian dollar is a risk currency. Okay. Talked about the Kiwi. Now I have a question about Euro Aussie, Euro Kiwi, and Pound Yen. Pound Yen, one of them. Wow, look what a move here. 164.50 is just another leg down. 164.20 has been the recent low. We can add one line here. This is one of the faster moving currency pairs. Lots of pips to be gained and lost. We had a fall under 166, and the fall is rapid, is massive. The range for today, for example, is already above 250 pips just today. Quite amazing moves on Pound Yen. Where is the next line? I believe it could be only the round number of 160, but let's take a look at the charts. We've already seen 164. Yeah, but that's not a new low. Let's put a line. I have to clean up this chart as well. Sorry for this mess. Anyway, 164 is support, not only because it was almost reached today, but also because it worked as nice support back in February 2014, nearly 2 years ago. Further support is at another round number I see here. The pair. This is a clear separator of ranges, 160, 160.20 maybe, and this was a clear separator of ranges in the past. And to the upside, we have 166 as support. Okay, so this answers the question of around about Pound Yen. Of course, risk off pushes the pair down because pound is risk, yen is safety, and if the mood improves, this cross should go up. And now let's answer Euro Aussie. Euro Aussie, another risk off is the Euro, risk on is the Aussie. That's why we're seeing this cross move up over 1%, 1.5% nearly. Today, this is the daily chart. It's not such a one-way street. Currently battling the very round number of 160. 162.35 is resistance. Very clear to see here how it capped the pair, and further resistance here at 165.70. Okay, support at 158. No, well, not so much. I would say very strong support, only around 154 for this currency pair, or a bit below, maybe 153. 153.80 more or less. Also here, doom and gloom means the pair moves up, but beware of the ECB tomorrow. And Euro Kiwi, the same advice applies. Beware of the ECB tomorrow. Here we have a stronger trend because the Kiwi has been strong for quite some time, not like the Aussie, but now the Kiwi is just losing it, and the Aussie is a bit more stable. So currently 172.27. We have some kind of line here. No, I would say, yeah, we're currently battling with this line, but not so strong. Very strong resistance awaits here. at 180, we're still, well, very far from that. 800 pips, but who knows with this gloomy mood. And today we already have nearly 300 pips of movement, so you never know. I would say also, yeah, these are the levels to watch. Okay, hope this answers the question. Should we buy the demand of AU? You probably mean Aussie dollar. I'm not sure, because we might also have fresh rate cuts from Australia. We might have more falls in commodity prices. But of course, the Chinese authorities could announce some stimulus, and that could provide support. And of course, US CPI today could be weak, and that could also hurt the US dollar. I made good pips on pound yen 2 years back and not traded since. It's Scorpion on steroids, and novice traders should not trade it, I think. Yes, it's also called the dragon sometimes, and I also like your expression, Scorpion on steroids. So yeah, it's Gepi, the dragon, whatever you want to call pound yen. It's a crazy pair. Please use low leverage if you're trading it, and remember, there are lots of pips there to be gained, but also to be lost. Okay. Yeah, so just take a quick look at dollar Swiss around parity. Euro Swiss moving a bit higher in range. I suspect that the Swiss National Bank is intervening there because the Swiss franc, well, the euro is also strengthening against the dollar, but I also suspect that it gets another boost from the Swiss National Bank. We're getting closer to 110, which is high resistance. Getting close to levels, well, the strongest. Okay, so we might get to the strongest levels since September. I believe it's a flight to, well, it should have been a flight to safety to the Swiss franc, but I believe that we're seeing here some intervention, perhaps by the Swiss authorities to mitigate a potential dovish move from the ECB. They want to weaken the yen before it strengthens because of the ECB. That's just my suspicion. Anyway, euro dollar is very, very stable in comparison to what we're seeing in other currency pairs and what we've seen in the past. Okay. Okay, so it's I guess it's time for the wrap up for the show. Let's just take one look beforehand at here the implied probabilities for rate hike by the Fed. They're about the same as yesterday, around 60% against the hike. They will surely change after the inflation figures. I can't tell if it's up or down, but markets are curbing their enthusiasm for a rate hike because also the United States has seen weak data. Okay. So this is the wrap up for the live market open for Wednesday, January 20th. Extremely busy markets, and we're back to the gloomy atmosphere. Yesterday we had a big dovish move from the Bank of England's Mark Carney. Said it's not the time to raise the rates. We're worried about inflation in the UK, China, the Eurozone, you name it, and they'll need to see more sustained growth, a rise in CPI. The bar is high for raising rates, that's for sure. That sent the pound tumbling down, and it also had reverberations in other places. Eurozone figures were a bit better than expected, but the euro moves more on safe haven flows and fears of the ECB decision tomorrow. New Zealand dollar was hit hard by a double whammy. The New Zealand milk prices, the global trade index fell by 1.4%, and more importantly, CPI plunged 0.5. This quarterly release implies perhaps another rate cut from New Zealand. We had oil resuming its falls, nearly making it back to 30, but then resuming its falls. Asian stock markets basically collapsing. The Nikkei is back to a bear market. So all this doom and gloom, how is it reflected on the charts? The big winner is, of course, the Japanese yen, falling to levels last seen many months ago, 116.24, almost reached 116. And this could be a source of worry for the Bank of Japan that the yen is a bit too strong, not only against the US dollar, but against the Chinese yuan, and basically everybody, maybe less strong against the euro. The euro safe haven is working. This trade is working. The euro is stronger against the dollar, and of course much stronger against other currencies. but not as much as you would expect. Ranges are limited because of fear that the ECB could join the currency wars. 110, 110.70 on the upside, 109, 108 on the downside. Here is the beaten pound looking towards the lows. The biggest fall came yesterday. We had a rise on inflation, and then boom, came Carney. 141.33 is the low for the day. I see support only 140. We're back to levels last seen when the Bank of England last moved in 2009. Okay, nearly 7 years ago. Big event today in the United Kingdom. The inflation figures, the jobs report, and the most important thing in the jobs report is wages. Wages are expected to fall to around 2% from 2.4%, and of course also jobless claims and an unemployment rate should be watched. Another big morning for the British pound in its weakness. Then we have inflation data from the United States. Watch core CPI year over year. This is still looking good, around 2%, expected to rise. Also, headline inflation is expected to rise because of the removal of base effects. Housing data is published at the same time, but will probably be ignored because of inflation. If we have disappointing inflation numbers, that could lower expectations for rate hike and push the dollar lower. The Fed has more emphasis on inflation, making it even more important today. Okay, and then we have Canada Day, if you wish. Big the rate decision in Canada. Canadian dollar just losing more ground by the minute. 146.73 at the highs, not stopping its rises during our show. The consensus currently is not extremely clear, but the Bank of Canada is expected to cut the interest rate from 0.5 to 0.25. And remember that the lower bound for them is minus 0.50. It's supposed to help the economy. On the other hand, they already have some support for the economy from the weaker Canadian dollar. Okay, so they might opt not to cut, but to keep the pressure on the Canadian dollar by releasing a dovish statement, following the footsteps of the former governor of the Bank of Canada, Mark Carney, that is now the governor of the Bank of England. Okay, so we might have a move over there. If we don't have a cut, it could be, of course, positive for the Canadian dollar, allowing dollar CAD to fall because it's a bit overstretched. All right, so big day for Canada. It's not only the Canada releases a report, the rate decision, and then a press conference by the governor. So we'll have, and also we have other figures in Canada beforehand that will probably be ignored. Manufacturing sales. More important for Canada is what comes out of the US, the crude oil inventories. They'll just get into the mix. They're released between the rate decision in Canada, between the rate decision and the press conference. So this hour between 3 GMT and I would say up to about 5 GMT until the press conference ends should be extremely exciting for the Canadian dollar. I know I'm talking more about the Canadian dollar than perhaps you want to hear, but I think also technically this pair is quite interesting. Aussie dollar, back to the low, 68.50, gloom and doom, 68.30, line to watch. 69 is back to resistance, but not so strong. The trend also here is clear. And Kiwi dollar is not looking so good because of the weak data. 63.60, current levels, 63.10 and 62.50 are support. 64 is resistance. All right, so I guess that's it for today. Let's see if we have no more questions. Okay, I wish everybody a safe and successful trading day. We'll recap everything that will happen today and that already happens during the show tomorrow. And of course, tomorrow it's all about the European Central Bank, Mario Draghi's press conference, the Draghi show. So we'll have a lot of excitement over there. Thank you everybody for coming and for the excellent questions. Any feedback is welcome. Yeah, doom and gloom. Yeah, yeah. I know I repeat this phrase a lot. I'll try to find to enhance the vocabulary and also maybe talk about other things as well. But this is really the dominating factor in markets. Okay. And for Forex traders, it just allows more opportunities, okay? Because movements are bigger with this turbulent atmosphere. So if it's going short on the risk currencies or going long on the yen, I think there are more opportunities than we had in the quiet weeks. All right. So okay. So that's it for today. Thank you, everybody, and see you. Bye bye.